So to put things into perspective, we've discussed hedge fund failures due to market forces so far. That was Amaranth, Carlyle Capital and long-term capital management. The case study for failure due to trading technologies that we're going to look at is Knight Capital. But before we get there, we need to discuss the first technology crisis that we tend to refer to as the quant meltdown or quant crisis. So during the first half of August 2007, several long-short equity hedge funds experienced massive losses, and in order to reduce their leverage positions and to generate cash, they obviously incrementally started to unwind their positions. The funds that were slower to unwind were further impacted by a drop in prices as the earlier funds unwound their positions, and so the snowball effect or vicious cycle occurred as the quant formulas triggered sell events, and so the liquidations led to greater losses, and so it continued. The bigger losses were those that came from the statistical arbitrage hedge funds, where the strategy involves positions with very short time frames, as well as the equity market neutral strategy funds, which typically have long short equity positions. So researchers attempted to explain these losses via the unwind hypothesis, or sometimes called the liquidation hypothesis. This hypothesis asserts that many of the hedge funds at the time took very similar positions. When one hedge fund with a similar strategy to you exits his position through forced liquidation, it obviously affects the next hedge fund, who then also in turn decides to unwind their position, and so on and so on. The unwind hypothesis suggests that hedge fund losses began with the forced liquidation of one or more large equity neutral portfolios, primarily to raise cash or reduce leverage. The research seems to indicate that over the 4 or 5 years leading up to 2007, hedge funds had gradually increased their leverage in order to achieve the kind of results they required. So obviously when things started to go wrong, they were perhaps over-leveraged and needed to unwind those positions quickly. So it's very similar to what happened to long-term capital management. There were a lot of people in the same positions. So if someone is also holding similar positions, we normally call this a crowded trade. Then there's a big risk for these strategies, because when all attempt to unwind the same kind of trades at the same time, the result is that everyone in the crowded trade gets affected. And the risk is further exacerbated by the use of technology that trades positions in a very rapid manner. So that's why in August 2007 it was called a quant crisis, as it was only these rapid quant traders making many trades over seconds and minutes that felt a 5 or 6 sigma loss on the 8th and 9th of August, as their algorithms triggered that they liquidate their positions almost simultaneously. What was interesting is that the major broad equity markets were not as severely affected. In fact, you'd hardly notice any change. Now let's look at the flash crash. On May the 6th, 2010, a flash crash occurred. This was after equity markets traded down by approximately 3% most of the day. So 3% was still a significant downward day, but later in the afternoon, the market crashed 6% within a 5-minute period, and then 25 minutes later, the market had reversed those 6% losses. It was recorded to be the second largest market price swing in history. The whole event took about 36 minutes to occur. So you can see the chart here of the 3 major indices, the rapid drop and then the quick recovery again. The entire crash lasted around 36 minutes. The cause of the crash was attributed to a British trader who was using spoofing algorithms. Now, spoofing is when large orders are placed in the market, but they're not really expected to be filled. We're not 100% certain of what occurred, but it's reported that this British trader tried to sell 75,000 E-mini S&P stock index future contracts, which represented a value of approximately $4.1 billion then. The market volume at the time was thin and volatile, and so such a big order in the market amplified the effect of the fall. As soon as the orders have an impact on the futures market, traders start to sell futures contracts, which results in the arbitrageurs selling equities in the spot market, pushing the equity prices down further. So the term spoofing, as we say, means placing of large orders to influence market prices with no intention of actually honoring the orders if executed. So how can the effect of flash crashes be mitigated? Well, it wasn't just the 75,000 order, but other traders obviously reacted to it, and some would have tried to front run the order. and eventually the market got a bit into a selling frenzy. And so a circuit breaker can be used to mitigate the effect of a flash crash. A circuit breaker basically halts trade in the event of significant market fluctuations. As a result of the break in trading, the market can assess the situation, they can take a breather and make more informed decisions before they go back into placing orders in the market. There is obviously some dispute about market participants as to the effectiveness of circuit breakers. Some argue that it actually harms the market and increases liquidity risks. The idea behind it is that it gives market participants time to digest information and formulate the appropriate trading response. Let's consider question 5 at the back of chapter 29 of the CAIA Alt Investments textbook. What is believed to be the cause of the flash crash in 2010? Well, initially the SEC reported that a backdrop of unusually high volatility and thinning liquidity, just as a large fundamental trader, a mutual fund complex, initiated a program to sell a total of 75,000 E-mini S&P contracts valued at approximately 4.1 billion as a hedge to an existing equity position. Subsequently, it's been alleged that the flash crash was actually caused by spoofing, the placing of intentionally deceptive offers designed to move markets by a trader or group of traders holding massive positions that hope to benefit from the market moves. Obviously, since then, spoofing is illegal. Let's have a look at Knight Capital now. Knight Capital was the largest equity trader in the US in 2011. They traded approximately 17% of all market trades. But towards the end of 2012, they installed an untested piece of software that caused serious errors in their trading system. As a result, millions of erroneous trades were inputted into the system, causing accumulated losses to Knight. At the end of the day, the total losses sat at around $460 million, and that came just from 2 days of trading. Over the next few days, several customers left the business, and the value of the business actually dropped by about 75%. The SEC attributed the losses to technological errors, or employees failing to respond to messages that the system was faulty before it went live. As a result, the SEC fined Knight an amount of $12 million for not having adequate controls in place to protect against these type of errors. The lesson we can really learn is that even small errors can be magnified as a result of technological errors on the speed of trade. So let's consider review question 6. What pattern of trading orders is believed to have caused Knight Capital Group's demise? According to an analysis by Nanex, a Knight algorithm appeared to have been repeatedly buying at the offer and selling at the bid, causing Knight to lose a small amount of money, or in other words, the spread on each trade, losing large sums due to the trades being repeated over and over again. An exam type question. Which of the following reasons least likely explains the reasons behind Knight Group's trading losses that occurred in August 2012? Weak internal controls, fraud, defective software, untested software. The answer is B, fraud. A subsequent SEC investigation found no evidence of fraud. Knight installed an untested and defective piece of software that caused the firm's trading system to enter millions of erroneous orders. It was found that the employees failed to act on automated email messages or internal controls that were meant to flag a potential problem prior to the start of trading. So this indicates weak internal controls. So all the others are really right. So the least likely there is fraud. Let's look at the next learning outcome, which requires you to demonstrate knowledge of major fund failures caused by fraud. The next few cases deal with fraud, which is basically internal deception, typical for the purpose of financial gain. And the first example we're going to look at is Bayou Management. Bayou started out as a legitimate hedge fund in 1996 by Samuel Israel III and Daniel Marino. Initially, the fund suffered losses, at which point it began fabricating its financial statements to try and hide these losses. A new company called Bayou Securities was formed to process and trade for the hedge fund. It's really a captive broker. Bayou Management was their only client. Bayou Securities earned commissions from the fund and in turn gave the fund rebates to hide any losses. As a result of the relationship, more trades than were considered necessary were executed, which we refer to as churning, which is to try and trade more often to make more commissions. In addition, higher than normal commissions were charged, and this was not disclosed to the clients. At the height in 2003, the funds claimed to have made $43 million US, and Israel told investors that Bayou would grow to roughly $7.1 billion US by 2006. Another interesting part of the story is in 1998, as losses mounted, Bayou fired their auditors and created their own dummy accounting firm called Richmond Fairfield Associates. The accounting firm created false records and financial statements, and again Bayou was the only client. By 2012, Bayou lost $49 million on trading and made $29 million on commissions because of all this churning. At that point in time, they closed down the Bayou Fund and opened 4 new hedge funds: Bayou Accredited, Bayou Affiliates, Bayou No Leverage, and Bayou Super Fund. These new funds also incurred losses that were covered up. The Super Fund, that was capitalized with $90 million of investors' funds, lost $35 million in a year, but still reported a profit of $25 million. So clearly, this was just fraud. In 2004, all funds stopped trading and assets were sent overseas. Bayou was revealed as a Ponzi scheme in 2005 when the SEC requested that the court freeze the defendants' assets and accused them of claiming to have made $43 million US in these 4 hedge funds in 2003 when they actually lost $49 million. When Bayou was unmasked as a fraud in 2005, many people lost a lot of money, but the media was given the pleasure of meeting Sam Israeli III, who, after conning almost $500 million from investors, faked his own suicide in 2008 before eventually being recaptured and sentenced to 22 years in prison. The lessons learned is that investors need to investigate the principals of a fund before investing. In this case, both principals lied about the length of time they had served at previous employees, so if someone just looked at the CVs of the managers, you would have seen they were dishonest about their credentials. Independent auditors should also be required for all hedge fund reporting and opinions. Nobody had ever heard of this accounting firm that was founded by Bayou, and if you just did a bit of digging, you would have seen that Bayou was the only client. The third point is regulation alone is not enough. Regulators aren't necessarily going to detect a fraud, so due diligence as well as regulation is required in order to ensure compliance. The review question at the end of chapter 29: what primary issue could a prospective investor have researched in order to avoid losses from investing in the Bayou Fund? A prospective investor could have researched the background of the principals of the fund, which would have uncovered evidence of dishonesty. In addition, the prospective investor could have researched the auditing firm and found that Richmond Fairfield had only 1 employee, a Bayou employee, and only 1 client, namely Bayou. So the next key word to be familiar with is a Ponzi scheme, which is a fraudulent program that returns deposits to investors and identifies the return capital as a distribution of profit in order to overstate the profitability of the enterprise and to attract additional and larger deposits. The fictitious profits distributed to investors are actually the capital contributed by new investors to the scheme. So a Ponzi scheme requires the continual recruiting of new investors to be able to sustain the fraud. And so we're considering the learning outcome around the major fund failures caused by fraud, and perhaps the most notorious cases of fraud and of a Ponzi scheme is that of Bernie Madoff. Madoff ran a securities firm. It was actually more of a brokerage than a hedge fund, but they had various feeder funds that allocated money to Madoff, including some hedge funds, and Madoff promised investors good returns with very low levels of volatility. Over the years, Madoff showed steady returns across all market cycles. In the early years, he may have actually traded securities for his clients, but it's doubtful, some think. But certainly as the funds grew, he never traded. He merely repaid redemption requests with funds that came in from new clients and basically created false paper trails or fictitious trades that never actually took place. And so a competitor in the field, Harry Markopoulos, he questioned the results of Madoff. The reason for this is that Madoff claimed that his returns came from an option collar strategy. This type of strategy involves going long an equity, selling a call, and buying a put with an exercise price lower than the call option's exercise price. The results of the strategy result in a profit within a certain range, which we call a collar. And the strategy typically doesn't allow for very large profits, which is what raised suspicion amongst the investors, particularly Markopoulos. And so Markopoulos tried to replicate Madoff's results using the exact same strategy, and he found it to be impossible. And so he turned his results over to the SEC on at least 5 occasions, but they failed to discover the fraud. In fact, they failed to do anything about it. It was only in December 2008 that Madoff's sons turned him into the authorities, and Madoff was arrested. He confessed to his crime, and the total cost of the fraud was estimated at about $50 billion US. So this was one of the biggest fraud cases. A key word to remember is affinity fraud. Affinity fraud was ignored in the case of Madoff, and this is basically when there are connections between the person committing the fraud and the victims. In Madoff's case, he relied on religious and other connections to gain the victim's trust. So the lessons to be learned is to not simply accept affinities. For example, if you're both from the same religious community. Secondly, Madoff's firm administered, executed, and declared all the trades internally. Madoff's return profile was not consistent with his stated strategy. An important point here is this one of restitution. Investors need to be aware of their responsibilities in the case of a fraud. They may be required to pay restitution under certain circumstances. There must have been some people in the case of Madoff who thought these returns are too good to be true, but they invited their friends into the scheme maybe just before they were about to exit. So restitution is the restoration of lost funds from investors who are enriched by a fraud, even if the investors were unaware of the investment's fraudulent nature. So this is something that can be ordered by a court of law. If we look at question 8 at the back of the CAIA textbook, why should an investor who exits a fraudulent scheme before it collapses be concerned about the losses for the investors who didn't exit prior to the collapse? Well, the answer to that is the courts can order investors who are enriched by a fraud to return the profits as restitution to those who suffered losses, even if the investors were unaware of the investment's fraudulent nature. The final case study to look at is the Lancer Management Group, which was an equity-based hedge fund founded by Michael Law, who had a good pedigree and a very good reputation in the industry. Ultimately, he was never personally found guilty of fraud. The strategy was to invest in small-cap stocks, both publicly and privately traded. The fund initially began with capital contributions of $600 million US, with assets eventually rising to over $1 billion US. Lancer was not transparent in their operations, but he often held large positions in illiquid, unregistered securities. In addition, valuations were performed internally and not by external experts. The firm eventually collapsed. At the end, it was worth only about $70 million US. One key word we should know is window dressing. This is a term used in the investment industry to denote a variety of legal and illegal strategies to improve the outward appearance of an investment vehicle or to pretty up your results. Another key word or expression to know is painting the tape, which goes back to the time when stock prices were recorded on an actual ticker tape. It essentially means when market prices are manipulated to reflect higher or lower prices on the public record. So lessons learned: funds need to be transparent. As a result of the liquid nature of the fund, Lancer withheld all information about the fund in order to prevent competitors from finding out their positions and taking advantage of them. As a result, investors were not able to fully analyze and appreciate the risks involved. Valuations were also performed internally and often by Michael Law himself as opposed to external independent experts. This created a conflict of interest with investors, as the higher the valuation, obviously the higher the fees earned by the firm. Law was involved in window dressing the results. He would perform transactions and valuations just prior to period end in order to improve the results. He also engaged in painting the tape, which was when markets are manipulated to reflect higher or lower prices on the public record. It's relatively easy with small caps or shares that trade in small volumes that are relatively liquid. Regulatory and audit safeguards were not adequate. The accounting firm hired did not discover the issues related to the conflict of interest and the valuation issues. Even when recommendations were made that certain valuations were too high and that an independent valuation be performed, it just wasn't done. In certain cases, after insistence by the auditors, a biased valuator was hired to perform the valuations. Several SEC reports were not filed, and had these been filed, the investors would have had a better appreciation for the risks involved. So the back of the question, review question 9. Why were the closing market prices of Lance's positions argued to be unreliable? It is alleged that Lauer manipulated the market price of thinly traded shares by placing trades at key points in time to print high prices in the stock's trading record, or to paint the tape, and thereby justifying placing higher values on the fund's holdings. Not only were the public shares not regularly traded at these prices, but also restricted shares held by Lancer were likely to be worth even less than the registered shares. So exam type question, which of the following suffered significant short-term losses due to an issue with their trading platform? A. Knight Capital, Bayou Management, CAIA Capital Group, or Lancer Group? Well, as we've discussed, the answer is A. The final learning outcome for this chapter has to do with demonstrating knowledge of 4 major lessons from analysis of fund failures. And very simply, I'm going to go to review question 10 because it asks it, list 4 major lessons from the chapter's cases in tail events. And so if we consider what we've just discussed, a consistent theme across many of the cases is the danger of using large amounts of leverage. Also, overconfidence of traders can lead to high risk and high losses. Highly quantitative financial systems using high-tech capabilities may contain risks that are difficult to predict. We think of Knight Capital. And then large fees and assets of the hedge fund would attract both geniuses and charlatans. We see Madoff was just out to really catch everyone. So we can add that doing thorough due diligence is basically the investor's best protection. In conclusion, let's just look at another 3 exam type questions that cover the entire chapter. The question is, a rescue attempt of Amaranth Advisors on September the 18th, 2006 failed because, and then ask you to choose one. You'll see there's 4 options there. The answer would be D. Amaranth's prime broker refused to give up collateral it was holding to back the trade. Goldman was willing to execute, but JB Morgan obviously wanted to hold on to the collateral. Alright, next question. CAIA Capital Corp quickly lost large portions of its newly raised capital due to, was it the fund held leveraged positions and the market was extremely stressed by Russian default and disruptions in Asian markets? B. There were high defaults and low recoveries on its corporate debt portfolio. C. CAIA held leveraged positions in securities that went out of favor. D. The fund made many different bets, but they were largely in the same direction. Well, the answer, if we're very careful, we could think it's A, because the first part is true, where the fund did hold leveraged positions, but it wasn't in Russian bonds. That was the primary reason for the failure of long-term capital group. So in this case, the answer is C. The fund primarily invested in mortgage-backed securities, supported by homes as collateral and by the US agencies and US government. And the final question, the fraud at Lancer Group could be best described as the recording of fictitious trades, affinity fraud, accounting fraud, or mismarking positions. If you're looking now for the best description, fictitious trades and affinity fraud were common with Madoff. Laser Group wasn't really known for preying on their acquaintances. Bayou Group's a good example of accounting fraud, and so D would be the correct answer, because mismarking positions probably best describes what occurred at Lancer Group. Well, that basically covers this chapter, topic 7.1, cases in tail events.